Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will deep dive into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new episodes released every Tuesday and Friday. Thanks for listening. Welcome to the latest episode of the Prime Property Finance Podcast. And in this episode, we are going to give you a little bit of an economic outlook for landlords. We're going to cover off what the economy looks like at the moment and what we expect to see with interest rates this year. We're going to talk a little bit about the mortgage market for landlords. Also, we're going to touch upon EPCs and those changes that are due to happen over the coming years. And we're going to just cover off a little bit about the Renters' Rights Bill. So, hi Mark, how are you?
Yeah, very well. You okay?
Yeah, good, thank you. So let's jump right in. So what are we thinking about the economy? What do we expect to happen this year? What are your thoughts?
Interesting crystal ball kind of chance? Or
Yeah.
No, it's a relevant question. It's always a relevant question, of course. Never more so, I would say, than currently. It's quite volatile out there, so very unpredictable. We've got a certain man in power in the US that seems to, if he sneezes, then the hurricane turns up somewhere else. So a bit of that to deal with. Question we get asked all the time by clients is, what's the prediction? What do we think are going to happen with interest rates? My answer is always the economists can't get it right, so we got no chance. But yeah, we see a lot of things that are going on. I think one of the main things really is around the relationship between base rate and mortgage interest rates. I don't think people necessarily understand that base rate and mortgage interest rates are not necessarily linked. So if you've got a fixed rate, or if you're looking at fixed rates, it may not follow the same trend that the Bank of England base rate will do. It's driven by something called a swap market. That is like a money market, if you like. We're also in a scenario where we are seeing 2-year fixed rates sometimes cost more than the 5-year fixed rate. And the reason for that is because of the volatility, the markets are having to price in some big variables in the next 2 years, whereas they see the next 5 years as being a little more stable. Off the back of that. So yeah, it's a massive topic. I would like to predict anything necessarily, but can certainly see how certain things can drive the market. And actually, we've seen them go down recently, whereas you would half expect them to go back up.
Yeah, stop sitting on the fence and
splinters in my bum.
Yeah. No, and I think you made a great point there around swap rates. But where we are at the moment, and where we see things sort of potentially going this year, we're in May now. Obviously with the podcast, it depends when this gets released. But in terms of, we'll try and put our thoughts on it. And I guess by the time this is released, then we'll soon find out whether our predictions were right or wrong. But I mean, we're due a committee meeting next week. And so, we've got to kind of expect, we'll put it out there. My anticipation is that we will get a reduction in this month's meeting from the Bank of England. So the Bank of England they don't meet every month. They meet every around 6 weeks. So it's not every month that we get one. And they're not always set in stone either. So they can be a bit flexible around holidays and things like that. So I anticipate that we'll have a reduction next month or this month, probably 0.25 basis points. It may be as much as 0.5%, but my anticipation would be a 0.25 reduction. We have started seeing lenders pricing some drops this week and over the last couple of weeks. Some rates are starting with a 3 now, which is very interesting to see in the market. So I don't anticipate we'll get lots of that. I think that's more of a news piece. There's a lot of criteria around that, but ultimately there is positive downward movement, and I guess the sentiment being we will probably get another reduction probably in the next meeting potentially as well. If they do only go down 0.25 this time round, then there's a good chance where we are with the market that we'll get another 0.25 sometime this year. And probably towards the end of the year, anticipate that we would just be around the 4, maybe the 3.75 mark for a base rate, and that ultimately means a great pace from a lending perspective across residential and buy-to-let for investors, because it makes affordability a lot easier on deals that haven't stacked over the last 12 to 24 months since the sort of Liz Truss mess that we had. So that would be interesting. So that's going to allow more people to come into the market. It makes more deals work. So there'll be definitely more demand off the back of it. The flip side of that, I guess, is the nervousness. If we go any lower than that, then that's potentially because there's bigger issues at hand. In which case, some people will be excited at the fact of lower rates, but actually, if we do get any lower than that, the nervousness is around there's more wrong with the economy than what we thought. In which case, there could be tougher times ahead. So, businesses are feeling the pinch at the moment in regards to some of the changes that have come in, obviously with increases to minimum wage and also increases to national insurance. Plus, at this time of year, we've had increases to council tax, water bills, and a whole host of other things that come in during April with the changes. So businesses are feeling the pinch, and obviously that translates across the board. And then obviously with some of these increases, also salary increases in government with the NHS and schools, they get their increases in April. Well, that brings inflationary pressures, and obviously inflation impacts what happens with interest rates. So it'll be interesting to see what comes out of the next few months.
Yeah, I echo that. I think with what's gone on, everything's happening this month. So as you say, the NI, the business rates, the minimum wage, everything. So businesses are now, having to make some tough decisions. Inflation is a lag, so we won't see the impact of this in the economy for a few months to come yet. Data is always historic, and it's always a backward-looking exercise. The government or the OBS, whichever one is going to report the figures, also can manage what's in that basket of goods to be included in that inflation number. Energy bills are going to play a big part of that as well. That's due to go up again. So whilst it all sounds negative, that's ultimately, as you say, going to drive the interest rates. It ultimately means that there's less to spend. But what that does mean, and one of the biggest drivers, I guess, to the mortgage market is not actually the investor, the market, the landlord. It's the home mover and the homeowner. If their incomes get squeezed, then you will see property markets, purchase prices coming down, because you can only afford what you can afford to borrow in the first instance, from that perspective, and rates form part of that conversation. So, yeah, it'll be interesting to see what is coming along. One thing I know, it's going to be volatile. It's going to change day to day almost, which is what we're seeing. And I do think so on these conversations, I don't see that people often win when they try to beat the market and they try to time when they fix rates and so on and so forth. From an investor perspective, if the deal works at this rate, just grab it and forget about it, and don't look at the interest rates for the next 4.5 years. If you lock it in for 5 years, you'll just have that FOMO and that piece.
Yeah, and also, like you mentioned previously, the difficulty is with Donald Trump behaving with, the big piece of news at the moment is around tariffs and how that impacts everything else. And like you said, they're such a big player, and from an economic level, how that impacts what's happening here in the UK is massive. So yeah, watch his space, I guess, and see what he gets up to next, and see whether he pulls back on some of those tariffs that he's been talking about. So more at a closer level then, in terms of the mortgage market for landlords specifically, I think is quite a good point to touch on. We're talking about cycles of fixed rates and things like that. Well, actually, this year is a massive opportunity, or also a massive market in terms of how many landlords mortgage deals are coming to an end. I think the stats that I've been told, there is about £23 billion worth of mortgage maturing this year. So those are people who did deals 5 years ago. They tied into 5-year fixed rates back in 2020 when the rates were much lower. So there's some good and bad news in all of this. I guess the bad news from an investor's point of view is that the average rate that they fixed at 5 years ago was 3.5%. And so when they come off those deals and when during this year, mostly in the middle of the year and towards the latter part of the year, that they're coming off 3.5% average, going on to an average of 5.09%. So there's a significant jump. The good news being, not that it's necessarily that good news for them, is that this time last year, those were like 5.69%. So if you'd matured those deals and matured last year, you'd be paying a lot higher. So there's a downward trend. The fact of the matter is, the rates are still higher than what they're on currently. And across the board, an average increase that a landlord is expecting to pay on their mortgage is £416 a month, which is a significant increase in what they're likely to pay. So all of a sudden, a property that they're making profit on, could be totally wiped out just because their mortgage rate is coming to an end. So that's going to affect people. And, ultimately, they're not going to be able to increase rents by that much to pull back that profit, which we'll probably talk a little bit more about when we talk briefly about the Renters' Rights Bill that's due to come in. But we can probably touch on that now. There's a significant number of landlords who are undercharging rents because they've had tenants in there for a long time. They don't want to upset the apple cart and various things. But there's a huge number of landlords who are undercharging rent, and this is probably the point that they may need to make that change now, because their deals are going to go up, and then they're not going to be affordable on the deals that they're going to be moving on to.
Yeah, and that's the danger of 5-year fixed rates, right? So yes, set and forget for 5 years. That's great, but you do need incremental increases in rents on an annual basis to keep it sensible for the tenant. They can't afford a 25% hike after 5 years, to keep that incremental. And I know there are a lot of landlords out there that have kept tenants, trying to look after kept rents where they are to try and help to help tenants. Easy for me to say. But actually, in the long run, you're potentially doing them a disservice, because if you need to increase your rent and then they have to look for alternative accommodation, the expectation is now completely out of kilter with what the market is actually charging. Now, whether you agree with the rate at which rents are increasing or not, and the housing demand and all of this sort of stuff, but ultimately, if you can work with your tenants doing incremental increases, sensible and in line with the inflation and market rates, etc., then you've got a fighting chance of keeping that tenant in situ at a sensible rent for a longer period of time.
Yeah, definitely. And the other bit of good news, I guess, from a landlord's perspective, is that yields have increased. So the average yield now are pushing 7%, whereas this time last year it was around 6.5%. So yields have increased as well. So some good news there. So let's move on then to some of the other bits in the economy from a landlord's perspective, some of the news in the market. Let's talk a little bit about EPCs.
Yeah.
The government, as we know, are trying to, and depending which government that's in, but obviously at the government at the moment, we're working towards net zero by 2050, and that's the law that they're working towards that. And one of the big items that they're trying to manage is to get EPCs, all properties, onto an EPC of C or above. And for those who are the properties that are let, they need to be, or for new tenancies by 2028, that all let properties are C or above, and that all tenancies by 2030 are C or above. The reason that they're doing this is they're trying to bring down the carbon footprint, and 20% of the UK's carbon footprint is taken up by housing. So obviously, the more properties they can make more energy efficient, the less carbon that we'll create, etc. So the difficulty is, from a landlord's perspective, I think it's 66% of landlords surveyed in the survey that was carried out have a property that's D or below, which means that there's a lot of landlords out there who have properties that don't meet this criteria. I'm being one of them. So I've been looking at some of the stock in my portfolio to see how I can increase those EPCs. There's lots of different ways to do it. The difficulty for landlords at the moment is there isn't exactly a guidance. There's talks around the EPCs changing the way they score EPCs. There's a lot of assumptions made in EPCs at the moment. So if you actually take the time to assess an EPC that you may have, is understanding the dynamics of what that's made up of, the fabric of the building, what you can do to increase it, what you can't do. Obviously, things in the past you could have done. There was cavity wall insulation, which was a really important thing that was brought in to increase it, and now it turned out to be a really negative thing, and it's being undone. So, it's understanding that the fabric of the building, is it insulated correctly? Are the walls, what can you done? Can you externally insulate? Can you add solar? Can you add heat pumps? There are lots of grants available in different parts of the country. So I'd implore you to explore what grants are available either through your local authority or nationally. I know in Wales, for instance, there's the Eco4 grants that is means tested, or if you're in a rural location, if you're not on mains gas or electric, then you can get grants to increase the EPC rating. So there's lots of support and grant funding available to landlords. So they just need to get on and look at those and see what they can do to do it. And another thing that you could do is get an air pressure test, potentially, because with older buildings, there's an assumption that they're quite poor in quality and they leak air. And so an air pressure test may be able to bring that and help you move up a point. So there are some cost-effective things that you can do to bring up the EPC of your property, but also there'll be we don't know what the outlook is from an EPC rating if that does come in and changes are made. And the difficulty from a landlord is you want to know what you need to do to improve it, but if they're going to move the goalposts, you might do some work now which may not be worthwhile and might be quite expensive to do. So it's weighing up the pros and cons of it. But ultimately, if you don't do anything, when this legislation comes in, the fine, you're not going to be able to rent your property, for one, and two, if you do rent your property without doing it, the fines are going to be significantly increased if it doesn't meet the minimum standards. So yeah, there's a lot that needs to be looked into here.
Yeah, I think one of the main things as well is, as we know, and you touched upon it there, the goalpost being moved, is these things have a habit of being kicked down the road. The date of the 2028 being further kicked down the road. We've seen it with electric vehicles and the non-production of new combustion engine vehicles. They've changed that because they realised it wasn't practical. And I guess the biggest challenge that I see for landlords is uncertainty. So a lot of people are sitting on their hands right now because they don't know what changes need to be in place by when. A lot of feeling is that, well, actually, they can't implement it. How are they going to police it? Therefore, they're going to push it down the road a bit further. We know it's a bill, an expense that's going to come down the road. So how do you budget for that? So, when you read the legislation around the EPC, if you can't, because some properties will never get to C rated under the current method, what is deemed to be I think the wording is such that you need to be seen to have spent enough to justify that you can't actually get it to the level. Well, what is that level? Is that 5,000? Is that 10,000? There's just so much uncertainty in this area that I think that is one of the major issues. If the legislation was written and it was black and white, then at least you know what you're dealing with and you can budget that and get it done. And especially those with larger portfolios, if 66% of these properties are D or less, then that's probably reflective in larger portfolios. 66% of those properties are probably not going to meet the standards. So I do think it's a ticking time bomb, but when is that bomb going to go off? That's the major question.
And the problem from a landlord's perspective also, so you mentioned about exemptions there, how you have to shown that you've spent X amount of money before you get the exemption, which is one thing. But the part of this is the actual cost is going to. So there's a huge demand. We've identified there's a massive demand. 66 of properties don't meet the current standard. So in order for people to put those changes in place, if they're looking at solar, if they're looking at heat pumps, looking at external or internal wall insulation, there's the cost of materials, but more importantly, there's the supply and the cost of labour, which is the difficult part in this. And as this deadline gets closer and closer, obviously the demand is going to increase, and so the supply of the labour being able to do this is going to go down, and so the costs are going to go up. At the same time, the government is as a mass shortage of new build housing that it's got to create, and a lot of the supply of material and labour will fall into that category as well. So if we look at a bit of a bigger picture, then there's a bit of a ticking time bomb here. And so, the advice would be to try and act now. There are lenders out there who have green products where they will give you a slightly cheaper rate if you have a C or above property. Also, one of the impacts of this is that landlords will start potentially looking at new build properties, which are already A, B or C rated, in which case they'll just start buying up that stock, this has become then an unintended consequence of this bill, which means that they won't buy lower EPC rated properties. They'll buy those, which will pull those out of the first time buyer market. And then first time buyers will be left with other properties which are lower EPC rated because the law doesn't apply to those types of purchases. So there's lots of different nuances that are happening in a wider scenario that people have to consider.
And I'm glad you mentioned green mortgages because, they're very much sold on the basis that obviously net zero and what have you, promoting that. However, lenders are also, with their carbon credits, also secure carbon credits based on the EPC rating or the carbon generation of its loan book. So its loan book, which has security in it, which is poorly performing from an energy perspective, actually costs them more by way of their carbon credits. So whilst it is very much promoted as you as a landlord will be cheaper, it actually helps their balance sheet and help them with their carbon credits because their assets are performing better energy-wise, which then means that it's costing them less to produce the money and so on and so forth. So, yes, that's there's a bit in the background. There's an incentive for the lenders to be issuing that.
And I think the lenders can do more on it because I don't think that the gap between standard rates and the green product is enough of an incentive for borrowers, but it's commercial for them as well. It's got to make sense for them. So maybe if the government want them to push the green products, then maybe the government needs to work with lenders a little bit more around how they can do that. But we leave the lenders and the government work on that one. Okay. Ultimately, I think that if you're a landlord and you haven't considered, from a broker's point of view, one of the things that we ask, when we're working with clients is, as part of the process is let's look at your portfolio. What is the EPC on your portfolio? Looking at all of the different properties and saying, right, how is this property performing? What can you do to increase, what are the risks? What are the costs? And you just need to certainly go through each of those properties in your portfolio one by one, kind of get an up-to-date EPC now, and see what works you can do and what investments you can do. Because another part of the study is that the properties with higher EPCs can actually command higher rents going forward, because this is one of the things now that people are looking for under the green agenda, is that people are actively looking to rent properties with higher EPCs because they know it's more environmentally friendly, and two, it costs less to run from a gas and electric bill point of view, from a utility point of view. So yeah, there's plenty of reasons for landlords to invest in their properties and get them to a better standard. Okay, Great. Well, let's move on to the final part of the conversation for today, which is around the Renters' Rights Bill. So the Renters' Rights Bill is a massive piece of work, legislation that's going through government, which is overhauling the whole way that people can rent properties and how you go about it. This has already happened in Wales. It's been under Rent Smart Wales, which has happened about 5 years ago, which is a massive change. I know there's certain things going on in Scotland, which is a completely different ballgame as well. So for the time being, for those who are unaware, the Renters' Rights Bill is just covering England in the main. It does impact some of the things that are happening in Wales, but it's mainly based on England. It's in the House of Lords at the moment, going through the committees there, and it's likely to be passed next year in October. We think it'll come into force. And so understanding what changes are going to be made, one of the things is there's conditions of properties. So there's any damp and mold within properties and how that's impacted. You can't increase rents for within 12 months. There's certain legislation around that, which taking the removal of Section 21 no-fault evictions, amongst other things. So there's lots of different things at play that will move the goalposts for landlords and make it's far more favourable for tenants then, should we say, than it is for landlords. And like we touched upon earlier around the number of landlords who haven't increased their rents in a long time, if they don't increase them now, when this bill comes in, it'll be even harder for them to increase them. The other thing that you won't be able to do is if you're marketing your property for a certain rent and there's competition for that property, then you won't be able to accept an offer that's above what the rent was advertised for. So there's lots of changes coming, and ultimately for landlords that have been around for a long time, this will be a big shift. And I think those will be the ones that will not suffer, but will be impacted the most by it, because they've been, impacted by lots of changes to the EPC, Section 24 taxation, plus a whole host of other things. So this is going to be another change, and this might be the one that breaks the camel's back for a lot of landlords who have been in the game for a long time and will look to exit because they're just fed up of it, but also provides an opportunity for new landlords who understand the rules of the game and want to run a business, and they want to do it properly, and they want to let properties that are in a good condition at a fair market rent, and serves a purpose. So, we know there's a big shortage of housing, both in the private rented sector and on the open market. So, what are your thoughts, Mark, on this?
Obviously, this has been rattling around for some time now. There's been back and forth a lot with it. It does I think the rhetoric and the narrative is very anti-landlord. It works on the assumption that there's a high percentage of bad landlords in the marketplace, which there isn't. We know that of the 2.5 million landlords that are in the country, that 82% of them own less than 4 properties. In fact, more than half of that population own just one, so are accidental landlords. So they're not bad in nature. They may not fully understand the legislation, but still they're there trying to provide housing for someone and so forth. So I do think this is a bit over the top in some regard. Some of it makes sense as to why it's coming in. I do see that. I do see the rent increases, and I do see this trying to make competitive. But I think my main concern with this is if it is going to drive landlords out, those accidental landlords that have the property that make up the major share of the property market for landlords, is if they start leaving, then it's going to further reduce the stock for people who rent. Some people rent through choice. Some people rent because they have no alternative. They can't afford to own their own home. That's just going to further drive up rents, and it's going to exacerbate the situation even further, in my view. So, ultimately, we come back to the main issue here is the housing shortage. We need to build more houses, not penalise the landlords that are in place. So, I think it's a challenge. How is it going to impact the market? Yeah, I think it's going to see some people leave. I think it's going to drive up rents, which, you used your yield figure as an example. It's going to drive up yields. You're going to have a longer queue of people trying to get into the property. So, yeah, I don't think it's particularly well thought out. And as you say, it's about it does sound very much landlord bashing. I just think it's not overly balanced in what it's trying to deliver.
Yeah, I agree with you. And I think, again, this is probably an unintended consequence, again, of a little bit of a poorly thought out reform or bill. But I think landlords are feeling the pressure of all the changes that have come in over the last few years. And like you said, an unintended consequence of that is less supply, more demand, which is making the problem worse and pushing rents up. And it's punishing the very people that it's set out to support. And so that's not a good thing, unfortunately. On the flip side, there are people leaving the game in terms of investors leaving the game. But last year there was over 61,000 new limited companies set up for the sole purpose of renting properties. So whilst we expect a number to leave those, what we do expect is that there are a lot of people looking to come into property investing, and ultimately property investing is still a really, really good vehicle. If you compare that to the stock market or cash or various other, precious metals and, other investing options, that people understand property, they know it, it's tangible and they understand how it works. Whereas there's lots of other things that you can invest in that they just don't understand. And so that's why, the UK property market is a long, stable, worldwide investment. And, we've got a lot of people from outside the UK who are trying to invest in the UK because it is stable and boring and very, very much a solid investment. So, like I said, the people who know what they're doing and what the rules of the game are currently, if they're coming into it knowing that these changes are coming into the Renters' Rights Bill or the EPC changes, they'll just change, and their business model will understand that, the Section 24, they'll buy through a limited company. So all of these things, people coming into it, like I said, with their eyes wide open, understand what they need to do. In that case, then they've got the energy to take that forward. So, ultimately the UK can't do without the private rented sector. It provides so many homes, and we have moved a little bit to a socialist state, and social housing is on the up. However, there's just not enough. The councils are under so much pressure already. That's just getting worse. And so I really think that there's an opportunity there for landlords as well.
Yeah.
And hopefully with interest rates coming down, then again, that will just support that.
Yeah, and I think the point of this episode, isn't it, is not to pick on one particular thing that's going to drive the market necessarily, but to understand there are a lot of moving parts in this space, as there are in other spaces. And these are just things that are going to influence where the market goes. So, we get asked, as I said at the beginning, is, what's your prediction on rates? Well, that's one piece of quite a large jigsaw as to your consideration. So, the Renters Reform Bill, we talk about EPCs, we talk about mortgages and all of these sorts of things. So I think having a grasp and an understanding of as much of that as possible, without the doom and gloom, hopefully, and just having some, what does that actually mean to you as an individual? It may not impact you that much at all. Whereas to the person sat next to you, it might have a massively detrimental impact, or to the other person on the other side, it could be super positive news because I'm already doing this, and that means I'm just at the front of the queue for the next tenant, and so on. So all I would say is with all of this stuff is just try and apply it to your own personal set of circumstances, because you may find that whilst there is a lot of negativity out there, actually the impact, that's rhetoric as opposed to the impact of on you rather, is negligible.
Absolutely. Well, look, I think we've covered a bit there. We don't want to keep going on, as again, we could talk about this stuff all day long. So, Mark, thanks very much for your time, and hope you guys have had value out of this. And if you have, please like and share, and hopefully other people can get value out of it too. Thanks very much. Have a good day.
Take care. Bye all.
Thank you so much for listening to our podcast. We hope you've learned something and have some tips to take away. We'd be very grateful if you could give us a review and subscribe to the show. If you'd like us to answer any questions or go deeper on a specific topic, then please drop us a message. And also, please follow us on social media. All our different handles are in the show notes below. Thanks.